For now, we are going to be validating supply and demand, and now we shall use VIX75 also for our illustration and GBPUSD. And then for now, don't mind about the time frame. It doesn't really matter much. For that one, maybe later on, someday when we are talking about the top-down analysis, that's when we shall be considering that. Yeah, for both GBPUSD and then VIX75, we're using the M1. I really like giving details because it really helps out a lot for more clarity. And now we are going to be seeing this. Now let me just come over here for some simple illustrations. And now we one time I was a student of the BTMM strategy. I believe some of you guys have heard of it. I like it and I use it. I use it also. And now in that strategy, I want to use some three words that Steve Maurer like could always use. It's the words induce trap shift, like the market maker moves, the market maker induces, they trap you and then they shift. So as we're talking about supply and demand, and then by the way, basically when I'm going also in details of order blocks, because let me first clear this. I believe order blocks are part of supply and demand. So supply and demand is the general thing, and then order blocks just fall in there. A bullish order block is becomes a demand zone, and a bearish order block becomes an area of supply. You get an area of supply. So that is for more clarity. And now I always like, by the illustrations that we're seeing here, the complex market structure. This is for the bearish, and this is for the bullish. And now I always want to start with a simple market structure. Now, for the simple market structure, basically, it helps us. It's like for the beginners. It's the basics. You get what is the basic movement of a bearish market? We make a low and we have a high. We have a lower low and we have a lower high, like that. You get? So here, generally, much as we have these points when we are buying, we can say that the market is bearish. And now we confirm that by the breaks of structure. You get? By the breaks of structure. So generally, when we are talking about supply and demand, for that case, if at all we move down like that and then we break a structure there, you get, when we break a structure there, that's when we bring in the point of order block. So this point here becomes a point of supply. You get? A point of supply. And now we could have, within the point of supply, we could have an order block, but then we can have order blocks just over there. Why do we bring in order blocks? Because we believe the market is going to be targeting those points for reversals. You get? So I think you're seeing, but within even this supply zone, maybe later on I'll be showing you in later episodes, but now within this area of supply, we could have an order block, and that one acts as an extra confirmation. You get? It acts as an extra confirmation. But now let's not first go on that. Now let's go for a simple market structure for a bullish market. A bullish market, we believe we move like that. So the moment we come and break a structure there, we have a break of market structure there. Now we start to think of order blocks, and now those order blocks are going to be along the path. They're going to be along that path, and now this one becomes the area of demand. You get? That one becomes the area of demand, and now within the area of demand, we could have a bullish order block, and now we could be targeting these points. Why? Because we know from a simple market structure, we move down and then we go back up. You get? Now this one becomes the retracement, this one becomes the impulse. And now for that one, now we really know. Now we are going on the complex market structure now, because it is the complex market structure, because this is the reality. Now the more we move in details, we get to the reality. When we leave here and then we go on the charts, it gets more tough. You get? It gets more tough. But if at all you've been following from the simple or from the basics, by the time we reach here, actually by the time we reach the charts, like everything will be clear. like everything gets clear over there. Now, for the complex, you get, now one of the things that we've seen here, you get, in both scenarios is the break of structure. You get, now as we come here on the complex structure, that's when we are going to be using the induced trap shift. You get, I really like those words because it's the reality that really happens there. You get, so not every point, not every time we come and break below like that is we've validated that area as a break of structure. No, you get, we have to confirm. So which means for a valid break of structure, we are going to look for an inducement, we are going to look for a trap, and we are going to look for a shift. You get, we are going to look for a shift. So the real shift is going to be breaking structure. You get, the real shift move. You get, so for instance, if I can demonstrate, let me use for one example for, let's say, a bullish market. You get, when we move this inducement, we trap and then we shift. You get, so the shift is the impulse, the longer move. You get, now on this impulse, that's where we are going to be looking for order blocks. You get, for order blocks, we like the impulse. You get, so we wait for it, then when we return, we target these points as points of entry. Let me not waste a lot of time on that. Now, what is going to be the inducement? Now when we get a move like this, we move down and then we move up. You get, then we move down and then we break above. You get, without breaking this original point, and then we break a point above, that is an inducement. You get, now when we move down and then we break this original point, by the basically, if at all we come and also break another point here, you get, another point there, without breaking this point here, I can also call this, all this is also an inducement. Inducement, I'm going to be using the letter X. You get, but now when we break, when we go above and then we get an inducement, and then we come and break an original point, that one becomes a valid break of structure. You get, it becomes a valid break of structure. Now we come and break this original point. So basically this was a single lag move, inducement also, bullish inducements, but we are interested, a valid break of structure is where we get a, we've seen an opposite break, or an opposite inducement. You get, for instance, we get an inducement, a bullish inducement, then we come and break a bearish point. That one is a valid break of structure. We move down, then we move back up. We take out this point here. This is inducement. You get, this is inducement, because if at all we broke above this one here, then that would be a change of character. But now we come, we take out inducement, then we come and we break down, then we come and also break another inducement, you get, because we've not broken below this original point. You get, now we can break, now this one becomes a valid break of structure. You get, now I don't want to waste a lot of time on these sketches. We are going to go on the root charts because that's where the most information is, but I believe here we are like digging the trench, like we are making a foundation. So now for the bullish case, I think it's really going to communicate a lot to us. It's going to communicate a lot to us. Basically, we have a move up and then we break down and break again above. This is inducement. We come and break below. This is a break of structure, you get, and then we break structure, but we are overall in a bullish move. You get, so someone could call this a break of structure, but generally it's an inducement because we've not taken out this low. But generally we are considering that we've not seen the origin of this point here. You get, this area here. So that's why for this case here I called it a break of structure. But even if we call it a break of structure, overall when you go on the charts, I believe the more you practice, you'll get more comfortable. So now, yes, we move up, we break a structure because we've broken, let's say, a structure, an opposite structure, and then we break above. This is a break of structure. We move down. We break above inducement. We break above inducement. we break below inducement, we break below, then we get, someone could call this a breakout structure, though we would validate this one more taking out this one, but let's not focus on that much. But we break an opposite point, we break another opposite point. This is a breakout structure, then we move up a breakout structure. Now let me go on the charts. So basically we've seen that they induce, you get an opposite move, inducing people into buying, yet they want to sell, you get. And now, by the way, so which means if at all we get this kind of point, this point here, this area here becomes our area of supply, you get. And now these zones, this one becomes our area of demand. This one is unmitigated, the market continues to move up. There is that time also for synthetic indices when the market comes down for days, but just coming for this point, you get, but just coming for that point. That's what really happens more so in synthetic indices, you get. There are some unmitigated zones. Now this is a mitigated zone, so I've even brought in the area or the concept of mitigation. But yeah, for those that are a bit well off, I believe you know mitigating, this is a mitigated area of supply. The next time we come, we are just passing it most of the time. But here, if we get this kind of scenario, the next time we come, we are going to rest in it and then we buy again most of the time, because it is an mitigated area of demand, you get. And even this one because becomes an mitigated area of demand. There's time when the market really gets funny, we come, we break, you get. They act as points of interest, by the you guys. These ones act as points of interest either for buying or selling. So yeah, let me not overstress things. So let me start here on GBP. And then we'll illustrate this. What do we see here on GBP? What do we see here on the GBP? Basically, we have these points here that are marked out, you get. We have this point here, you get, the point over there. Now for this point, and then we have a low here, by the way. We have a low here because we took out these lows here. This is a swing low, you get. We have a swing low there, then we move up, then we come down. We've not gone below this point here, then we break a point above inducement, then the market shifts. Now we started break down, you get. But now we've not yet gotten a break of structure because this point that took out the inducement is still protected, you get, is still protected. Now the market takes out an inducement now, which means we are in an area of demand. We have an area of demand here, you get. So it is most likely that the market is still buying, not until we start to break areas of demand, you get. So the moment we come and take out an inducement, and then we come and break down and we break this original point, now here I validate this to be a break of structure.